Hello, I'm Ross Mould, AJ Bell's Investment Director, and today I'd like to briefly talk to you about the referendum on EU membership that's planned for the 23rd of June. And in particular, I'd like to look at what the two possible outcomes could mean for your portfolio. So the first outcome is the UK population votes to stay in the EU and preserve the status quo. In this event, it's possible, logical, that first, the pound rallies to regain some of the ground it has lost against both the euro and the dollar in recent weeks, as per this chart here. Second, gilts see prices rally and yields go lower again as uncertainty is removed and UK government bonds retain their haven status, especially as there is less danger for overseas holders of the paper if the pound rallies. Third, stock market, well, may remain relatively unmoved, although there could be a relief rally if any uncertainty is removed. After all, Prime Minister Cameron would find it hard to survive a defeat in the vote, prompting a Tory leadership contest. The Scottish National Party would also argue an exit represented material change and grounds for a second referendum ballot on independence. Both votes would simply add to uncertainty, so doing away with them may help. Now that said, there are no guarantees. The UK stock market actually went down after the Scottish vote before launching a 6-month rally that proved pretty short-lived, so not much relief there. And the FTSE All-Share then peaked very shortly after a post-election jump last spring. No relief there either. The FTSE All-Share even rose sharply in initial trading on Monday morning, so it's hard to be dogmatic about the potential impact, especially as the stay and leave campaigns differ hugely in their estimate of the negative or positive effect on the UK economy overall. But it seems possible, logical, that in the event of a vote to leave the EU, first, sterling would slide given the uncertainty caused by the lengthy exit process and subsequent trade negotiations. And do note the pound lost 1% on Monday morning in opening shows after the referendum announcement. Second, gilts could wobble, as the 10-year yield of 1.4%, it's pretty skinny and could easily be wiped out by falls in the pound if you're an overseas holder. And do note a third of the gilt market is owned by foreigners. This is important. The UK runs a budget, trade and current account deficit, so we bring in less than we earn. This means we're dependent on funding from other countries. And if they take fright and stop buying or holding sterling assets, well, that could be awkward. In an extreme, and I stress extreme scenario, it could even hit the pound so hard, the Bank of England has to jack up interest rates to defend sterling. Third, although it's hard to see a repeat of the currency crises of 1967, 76 and 92, it is worth bearing in mind this worst case scenario in the event of an exit. Although Governor Mark Carney may actually be pleased to see the pound go down. After all, it will boost inflation and potentially exports. If sterling does fall sharply on an exit, analysts at Avalon Capital Markets argue a selective approach to the UK stock market could be needed, since a weak pound brings potential winners and losers. In the event of a plunge in the pound and rise in interest rates, Avalon suggests UK domestic players like retailers, property, house builders, financial services and broadcast media may lag. Equally, the analysts assert that sectors which are heavy exporters or got a big chunk of their assets overseas may benefit. Potential candidates here will be aerospace and defence, beverages, tobacco, personal goods and even the downtrodden mining sector. If you really believe that the referendum will see a vote for Brexit and that sterling will fall as a result, and they're decisions that only you can take, then a further option to consider is buying overseas assets, either directly or through a fund, as their value will rise when translated back into pounds. However, any such trade bring in their own risks, including that their price could fall faster than that of the pound, leaving you worse off than before you started. Ultimately, given the uncertainty, you may feel inclined to do nothing and leave your portfolios unchanged, since none of us has a crystal ball and there are so many variables. At least, that would avoid unnecessary trading costs as the 23rd of June draws nearer. Thank you for watching, and I look forward to seeing you next time.